FOMO in the stock market, understanding the fear of missing out. The term FOMO, fear of missing out, has become increasingly relevant in modern investing, particularly in the age of social media, 24/7 news cycles, and the rise of retail trading platforms. FOMO is a psychological phenomenon that drives investors to make decisions based on the fear of missing out on potentially lucrative opportunities rather than following a disciplined, rational investment strategy. In the context of the stock market, FOMO often leads to impulsive and emotion-driven decisions, which can have significant financial consequences. The psychology behind FOMO in investing stems from cognitive biases and emotions. Humans are inherently social beings, and when we see others experiencing success, whether it's a skyrocketing stock price or a viral investment story, it triggers a fear that we are missing out on the same opportunity. This is often amplified by herd mentality, where people follow the crowd, assuming that the collective wisdom of others must be correct. Social media platforms, online forums, and sensationalized news coverage exacerbate FOMO by highlighting success stories and creating a narrative of easy wealth. For example, during the GameStop saga in early 2021, many retail investors bought into the stock purely because they feared missing out on what seemed like guaranteed gains, despite the lack of fundamental value supporting the inflated prices. Common triggers of FOMO in the stock market. 1. Rapidly rising stock prices. Investors often feel compelled to buy into a stock when they see its price skyrocketing, fearing they'll miss out on future gains. 2. Hype around IPOs. Initial public offerings, IPOs, frequently generate FOMO as they are marketed as unique opportunities to get in early on a potential success story. 3. Media and social media hype. Platforms like Twitter, Reddit, and YouTube amplify success stories, making investors feel like they are being left behind. 4. Peer pressure. Friends or colleagues boasting about their investment successes can also trigger FOMO, leading individuals to copy their trades without proper research. 5. Market trends. Bull markets, in particular, are breeding grounds for FOMO, as rising prices create a sense of urgency to join in before it's too late. Risks associated with FOMO. 1. Overpaying for stocks. FOMO often leads investors to buy stocks at inflated prices, right before a correction or crash. By chasing trends, they ignore fundamentals and may end up holding overvalued assets. 2. Neglecting due diligence. In the rush to capitalize on a perceived opportunity, investors driven by FOMO frequently skip essential research, such as analyzing a company's financial health, competitive position, and industry outlook. 3. Short-term focus. FOMO encourages a speculative mindset, prioritizing quick gains over long-term investment strategies. This increases the likelihood of losses due to market volatility. 4. Emotional decision-making. Emotion-driven trades often result in panic selling during downturns, locking in losses and missing out on potential recoveries. 5. Portfolio imbalance. Succumbing to FOMO can lead to overconcentration in high-risk or speculative stocks, reducing diversification and increasing portfolio risk. Real-life examples of FOMO. Dot-com bubble, late 1990s, the rise of internet. Companies created a frenzy, with investors pouring money into technology stocks, many of which had no earnings or viable business models. The bubble eventually burst, wiping out billions in wealth. 2. Cryptocurrency. Boom, Bitcoin and other cryptocurrencies have been prime examples of FOMO. Many investors bought at peak prices during 2017 and 2021, only to experience massive losses during subsequent crashes. 3. GameStop and meme stocks. The GameStop rally of 2021 was fueled by retail investors on Reddit, many of whom entered the market purely out of FOMO, disregarding the company's fundamentals. 4. Tesla's meteoric rise. Tesla's rapid stock price increase created a FOMO-driven buying spree in 2020, with many retail investors jumping in without evaluating the company's valuation or risks. Combating FOMO, strategies for rational investing. 1. Develop a long-term plan. Establish clear investment goals and stick to a well-thought-out strategy. This reduces the temptation to make impulsive decisions based on short-term market movements. 2. Conduct thorough research. Make informed decisions by analyzing a company's fundamentals, industry trends, and valuation metrics before investing. 3. Diversify your portfolio. Avoid putting all your money into one stock or sector. Diversification reduces risk and minimizes the impact of poor investment decisions. 4. Set rules for buying and selling. Use predetermined criteria, such as target prices or stop-loss orders, to guide your decisions and avoid emotional trading. 5. Limit exposure to noise. Reduce time spent on social media and sensationalist news outlets that amplify market hype and trigger FOMO. 6. Focus on value. Invest based on intrinsic value rather than price trends. Avoid buying simply because a stock is going up. 7. Learn from mistakes. If you've fallen victim to FOMO in the past, reflect on the experience and use it as a learning opportunity to avoid repeating the same mistakes. The role of education in overcoming FOMO. Education is a powerful tool to counteract FOMO. By understanding the principles of value investing, market cycles, and behavioral finance, investors can make more rational decisions. For instance, reading books like The Intelligent Investor by Benjamin Graham or studying the strategies of successful long-term investors like Warren Buffett can provide valuable insights and discipline. Additionally, learning about common psychological biases, such as loss aversion and confirmation bias, can help investors recognize and mitigate their emotional impulses. Conclusion: FOMO in the stock market is a powerful and pervasive force that can lead to poor investment decisions and significant financial losses. Driven by psychological biases, media hype, and peer influence, it tempts investors to prioritize short-term gains over long-term financial stability. However, by developing a disciplined approach, conducting thorough research, and maintaining a focus on long-term goals, investors can resist the lure of FOMO and make more rational, informed decisions. In the end, successful investing requires patience, education, and a willingness to stick to a strategy even when others are chasing the latest trend. Remember, the market will always present opportunities, and missing out on one doesn't mean missing out on all. A rational approach will always outweigh the fleeting gains of emotion-driven decisions.